So I'd like to thank everybody this morning for coming, and Marty, great job putting this together, as always. This morning, we're going to be having a discussion on artificial intelligence. It's an emerging technology that will be used to create systems that parse images and videos, understand and translate text, diagnose medical conditions, and many, many, many things. I think a parallel for this is the impact that's, the internet had on our economy, the way it's changed our lifestyles. And I think this is going to be fairly comparable. This morning, we're going to focus our conversations on the impact on trading strategies. We'll do this from a couple different viewpoints. One is, AI making trades. AI is a market sector in which people can invest. AI's impact on the business of trading and how we're all going to be dealing with that. To my right, we have Konstantin, and maybe you saw his presentation yesterday. He is the CEO of TenViz, a very interesting model that he put up, and I really enjoyed your presentation. Thank you for that. Thank you. To my left, we have Michael Weinberg, and it says on Marty's agenda, he is an adjunct professor at Columbia University, which grossly undersells his capabilities and here in AI. He's been dealing with this issue for years. He is also part of a French family office, but he'll go into details on that in a minute. And online, we have Scott Warren. So Scott, welcome and good to see you. He's part of Quantitative Investment Strategist up in Boston area. My name is Mark Heil. I've been around alternatives since the mid-90s. I hate to admit that, but it's true. In the capacities of marketing, capital raising, fund administration, and helping investors and tap into their retirement funds to make investments. So I've seen alternatives from a number of different views. Now I have a quick trivia question for our audience. Can anybody tell me who the Honorable Edward Everett was? It's a history question. Anybody?
No idea.
Well, he was the guy that spoke before Abraham Lincoln at Gettysburg. He spoke for about 2 hours. Nobody remembers a word he says. Abraham Lincoln spoke for about 2 minutes. So my point is, we're going to have a conversation up here in front of this group. When you're asking a question and you join in it, we want you to join into it. I'm asking you to focus your comments down to the essentials and ask your questions kind of straight away, rather than go into a big, long discussion. If we need more context, we'll ask you for it. Don't worry. These gentlemen are very capable. So, as I mentioned earlier, we're very fortunate to have these gentlemen. Konstantin, would you do us the favor and kick us off and just talk about yourself and also talk about TenViz and what you do?
So, Mark, I appreciate the introduction. Marty, thank you so much for hosting. I will actually start with what Marty was saying in his opening remarks. Marty said, quoting him loosely, humans tend to sell stocks early. On the opposite side, they tend to buy late, or they tend to buy local highs. And that's actually what we started building out. That was the whole purpose of AI that we do, to help essentially discretionary traders to enter positions in a better manner, in a more timely manner, because the timing is everything. And with that in mind, actually, we launched my company like 8 or 9 years ago. And then our name, TenViz, in Latin stands for clear or straightforward, right? So we simplify the world essentially like to the very, what is actionable right now. And we don't rush to act on it. We just wait. And like when something is interesting, then our tools signal that. So that's the genesis of what we do. Help humans be better investors with the help of AI. That's our vision.
Beautiful. And just to be clear, and I think you made this point yesterday, you have an advisory service, which is half your business. Maybe it's a little more than half, I don't know. And then you also run SMAs for certain groups and make investments using your model.
Correct.
Very good. I'm going to skip to Scott next, and then we'll come back to Michael. So Scott, if you would do us a favor and just tell us a little bit about yourself and Apex Quantitative.
Okay, thanks, Mark. Let's see. I started investing using AI in 2009. I had a problem, which was how to short the euro when I was asleep at night because the markets run 24 hours. So that's when I first bought an algorithm off the shelf and started training the parameters to help me with something I needed to do as an investor. So ever since then, since I was kind of an opportunistic investor and trained the AI to do what I want, but I didn't have something that was always in the market long only. And so I've been looking for an AI that's long only, always in the market and trading, which is something I'm not good at. That's how I ended up finding the team at Apex. We've been in the market now about 3 years. We built an AI for multi-factor trading, and we finished in July our 3-year track record. But I think I'm going to focus more on just talking about AI and investing in general than on the current project, based on advice from our lawyers.
Understood completely. We will keep it to a very general level for you, but to the extent you can give us some insights as to how you think about things at your company, that would be helpful.
Absolutely. Delighted to be here with you guys and with such a great panel.
Terrific. So, Michael, why don't you take it away here and give us a little background on yourself? Tell us about how you got into AI and all the different areas you've touched it.
Sure. Been investing for 30 years. First as a direct investor, as a PM at Soros and Credit Suisse. Then the last 20 years as an allocator at firms like FRM, Man Group, APG, the Dutch Pension, First Republic, and Protégé Partners. At Protégé Partners, we founded a firm called Move 37. And the concept was that machine learning and alternative data, this was, as Marty alluded to, actually 7 years ago, we were quite early, that machine learning and alternative data would revolutionize investing. Still have that view. And also teaches an adjunct professor at Columbia Business School. I'll pause there and we
Sure.
can go.
No, that's fantastic. And one of the things I think Michael really brings to the table is he's used this to help evaluate managers, right? That's something that every family office does and is interested in. So I think he'll bring that insight into this conversation, particularly as it pertains to AI, since he has that experience on both as the person who ran it for a firm and now as somebody who's buying those types of systems and using those trading strategies. I saw an article, a definition online for AI, and I'm not terribly in love with it, but we'll use this as a starting point, then they'll chime in with some thoughts on what really makes AI. And the definition was, artificial intelligence is where algorithms have the capability to automatically learn from data and make predictions. I don't know about you, but this does that too, right? So it has to be something about AI that is better, gives you an advantage, helps you do it. Konstantin, you had some thoughts on our prep call in this area. Why don't you start with you here?
I will probably reiterate the same message I had yesterday. And again, in the domain, at least in finance, I would define it like do something that is not obvious to humans. i.e. better, i.e. cheaper, i.e. more efficiently, but yet the insight has to be unexpected, something that people don't see.
Michael, do you want to?
Yeah, I mean, faster, cheaper, more efficiently. Agree. I mean, that was one of our premises, again, 7 years back when we founded this company called Move 37. But the premise still holds, which is that, yeah, machines can do what I was a discretionary portfolio manager at Soros and Credit Suisse, for example. Yeah, I could look at maybe 100 securities at a time, maybe 100 data points per security, whatever math you want to take in terms of securities and or companies and or data points. The machine can look at 10,000 companies globally, 24/7, doesn't get sick, doesn't need overtime, doesn't get tired. It can do it faster, cheaper, more efficiently. And to Konstantin's point, the machine can find relationships. Now, again, they have to be statistically significant, and but the machine can find relationships and things and see patterns. And again, what is investing? Investing is all about pattern recognition. The machine can see patterns and find relationships that humans could never find, or would never find, and nuances that are too fine for humans. Now, again, I do think the combination is human plus machine. And again, there has to be statistical significance, but I'll pause there.
No, appreciate that. Scott, do you have anything to contribute to this?
Yeah, it's a tool. Great comments. It's a tool, and it can replace, I mean, nothing against analysts or a team of analysts, but I mean, I can get, I mean, you have to have a good human team kind of knowing what you want it to do. It can be a research tool and generate insights, but it's also a great, if you know what you want to do, you can train, you know, using machine learning, you can train it to be better than any team of humans can be, particularly at finding nonlinear relationships that might be nobody's ever noticed before. Like say you have like whatever, 8 data points that have some predictive value, and there's some of them are correlated or inversely correlated. It can find these or tell you the relationships maybe with your other data points, and it can do it rapidly. So it's just kind of beyond what a human team can do. And I view a market as a complex nonlinear system, and so I'm particularly looking for those those insights to find out what's going on under the hood. So yeah, machine learning, I think that's the way to go.
I would build up a little bit on what Michael was saying. Essentially, still 99.9% of AI use on Wall Street is concentrated on relatively simple tasks, really straightforward tasks, like essentially anomaly detection. Like say, if this credit card transaction happens this and it doesn't mention that, like it kicks in the red flag, right? We call it in machine learning or in data science classification problems, right? They're extremely well understood. Machines are extremely well done at that. And also, machine learning is still and high frequency trading, which is roughly the same idea. What we're talking about is actually telling and seeing something that hasn't happened, but might happen down the road. Like we were able to see that Brexit in 2016 would be negative. People expected that the Britain would vote to stay. We saw that, no, that's not likely to happen. So that is the insight that we try to see through the time series, which are inherently non-stationary, i.e. their patterns of behavior in the future might not depend on the previous behavior completely, and the patterns of regimes change. So without getting too technical, I'm saying that the pattern, we see probably a transition, definitely on Wall Street, from just pure classification problems to what is sort of like, what is the prediction, right? What the prediction is. Allow me to add that.
I thought you gave a great example too on real estate yesterday. That was, a little bit more to trading, perhaps not as obvious to everybody. So do you want to talk a little bit about what you saw in real estate?
This is actually coming in, reinforcing the point that Michael has said, a synergy of a human and a computer. Our tools did see inflow in the middle of the last year, approximately July, flows into home builders. And we were puzzled, like everybody would say, hey, higher rates would kill home building, real estate and housing, and it didn't. And when we dig from the fundamental perspective, we clearly saw, hey, inventories all-time lows, like 40, 60-year lows, right? So it's like a clear insight, hey, humans able to see that inventories matter a lot, right? There was no inventory in the market. And our tools were saying, timing, like, now the market wants to buy home builders. They're cheap, they're already priced for disaster, and it's not gonna happen. By the way, the same effect was in 2002, 2003, when home builders were also priced for correction after the dot-com bubble. People thought that consumer would get killed and rates will kill them. Didn't happen.
Right, well, I think the point that Konstantin's making is, again, this, which is the point that I was making, which is the computers can see patterns that are not necessarily obvious to humans. And again, the computer, again, for last year when if for example, mortgage rates are rising or rates are rising massively, it's pretty contrarian to then say, oh, I'm going to go out and buy the home builders. But actually, that's exactly the right thing to do. But the computer, isn't selling bottoms, and the computer doesn't have the same inclination as, if you look at behavioral psychology, humans do, which is to, buy tops and sell bottoms. So again, it's another advantage of using the machine, or man plus, or human, man, woman, whomever, plus machine to invest. There isn't the same, and the other advantage is, the machine isn't accountable to an investment committee or a CIO, where again, if you're going to a CIO or an investment committee and you're saying, I think we should buy home builders, and they all look at you and they say, are you crazy? Rates have just gone up massively, homes are unaffordable. you don't have that issue.
We had a question in the back, so.
You know, pretty soon
I
it's
was
going
gonna-
to come down to choosing managers who've got a better AI computer or software. I mean, these, you know, once you get 2 or 3 of these things in the market, all detecting the same dislocations, you know, those dislocations are going to be narrowed and disappear. I mean, you know, this is a very evanescent period where you may get an advantage, but pretty soon AI versus AI is going to rationalize the market. Many of these things will disappear.
I want Michael to respond to that, then we'll come to you.
Yeah, look, I mean, first of all, if you look at, first of all, there are so many markets. There's credit, there's equity, there's real estate, there's commodity, you know, there are so many markets, then there are so many different timeframes, then there are so many different data sources. And again, sure, if everyone's using the same Bloomberg data or structured, again, you know, structured financial data, that might be the case. However, there's structured data, there's unstructured data, there's financial data, there's non-financial data, there's corporate data, there's Freedom of Information Act data, there's IoT, information on thing data, Internet of Things data, and on there's private company data. So our contention would be there's so much data, there are so many markets, there are so many different time frames, there are so many different machine learning techniques, there are so many different ways to ensemble all of this. That's not really going to be a concern for some time, if at all.
I agree entirely.
Michael, sorry, could you just clarify one thing? Because I know you know because we know each other. But there's metadata and there's market data and company data. Those are numbers on the left, just numbers. The stuff on the right is we don't know what's useful from an investing standpoint out in the world, and somebody can go look at it. You know what I'm saying? So I'm just trying to separate the two. There's market data, company data, like you said.
Right.
Then you said out there's all this other stuff. And could you just talk about how to use all the other stuff? Because
yeah, and absolutely. And I mean, to me, that's where the inefficiency lies. And I've written I wrote a paper on this that Kaya published. I can send to any of you. But exactly, I think that's the valuable, to me, the more valuable and more inefficient data is the data, one second, to the left that you're referring to. That like everyone subscribes to Bloomberg, every multi-manager, Citadel, Balyasny, Millennium, et cetera, subscribes to Bloomberg, the satellite data, the credit card data. Anyone with a few $1 million can afford those data sources. Those are largely more efficient. However, the inefficient data is private companies, Internet of Things, Freedom of Information Act, web scrape data. That's where I see the value and the inefficiency, where those data sources may actually even be free. And Marty, yeah, go on.
What about unstructured data as well?
Totally, unstructured data, video data.
So look, unstructured data is like drone data. Like somebody came to me and said, I got a hedge fund, we're trading, it's a real estate fund, and we're looking at development by putting drones at IKEA and seeing where people who drive expensive cars are going to. Right? And maybe that makes no sense, but maybe AI makes sense of it. I don't know.
No, but Marty, but again, that's an evolution. Like when I was a PM at Soros, we had a fellow, Nick Roditi, who's still in the investment business, sort of a legend in the business in macro. And Nick used to have people, in the Gulf counting tanker ships and tanker levels. Now all that's online for free. So some information has become commoditized, but what you're saying is no different than that. You could ensemble data sources like that, and that's what managers are doing to have an information edge.
That was the whole premise.
He's been waiting for a while. Come on in.
Good to see you again, Mark.
Good to see
Been a
you.
while.
Yes.
The criteria I have is data is everything in AI. To provide data to run a machine is very simple because it's consistently over and over again and no change. When you're dealing with the markets, something that changes that quickly, that fast, how do you determine what data is in there? And if data is missing, as you're pointing out, there's a lack of information there that the machine can't give you information on, and it's changing so fast. How do you adapt to that? That's a very difficult thing to do.
I don't want to hog the panel up.
No, that's all right. Konstantin or Scott?
I can actually give a
Technical problem,
take a
you
first
have to
crack at
fill in
that.
the gaps.
You knowing more wouldn't
I
hurt.
think Scott had a response. Scott?
I'm just saying it's a technical problem. There are ways to fill in the gaps. So yeah, the data is imperfect, and so you have to fill in a lot of those holes and know how to do it the right way. And specialists in AI know how to do that. It's a data analysis problem.
Exactly. So knowing more data wouldn't hurt, but it's not the most important thing. Obviously, like Scott is referring to, and we do it routinely, we can estimate gaps from other relationships. If the data set is good enough, it actually can uncover relationships, something that is not obvious. Like I can reconstruct it from the shade of this pen, two-dimensional shade, that is three-dimensional just by looking at the two-dimensional space. We do it routinely. And I can give you a more specific example. Like sometimes people ask us, like, do you look at, say, options, pricing, volumes, and everything, or you just look at the underlying price? In our sense, we don't even need to look at the options per se, because whatever happens to options, brokers who write them actually will be do data hedging by definition, right? So that pressure would be immediately felt through the stock prices alone, right? So again, we don't need to see all the derivative instruments to see the underlying behavior. We can read that off of the underlying. Does it make sense?
Who's reading it? The individual is making the decision, or the machine is providing the data for you to make a decision? Who's making the decision?
Machines do the both. They provide the data, they extract the data, and they make conclusions.
That you act on?
Yes, that we put in front of the humans, act on that.
Years ago, many of us heard that your voice is the best way to distinguish people. And so now some of us, dealing with people like Fidelity, they identify you by voice. Where is this going? With AI, what's the next way of identifying people? What happens?
And I would just, as an add-on to that question, there's talk
Sorry?
about, as an add-on to that question, there's talk about that being very risky because AI can mimic your voice.
Yeah, that's the point. That's the point.
I mean, I know someone, and it wasn't a voice mimicking thing, who the emails were intercepted by the scammer, right? An art gallery sent an invoice, the scammer stopped the email in the middle of the transition, changed the wire instructions. So the buyer of the painting gets the invoice with the wire instructions, wires the money, and the money's gone.
That's happening a lot now.
Yeah. So, and with this AI voice recognition, they're saying that, when my banker calls me and says, I just want to confirm that you wanted $5,000 in cash sent to your house or whatever it is, if I'm a hacker, I've hacked my phone and I've got somebody who's already knows what I sound like. So she doesn't
It's
know.
almost easy though, because when you get a call from a bank that says you got to do something right away and you can't confirm it or something, but what's really, and I'm not comparing notes.
They intercept the call to me
Whatever,
and pretend that they're me.
all the above, all the above.
Yeah.
There's an AI program for that, don't worry about it.
Where is it going? What's the next, how are we going to distinguish ourselves?
Well, I'll just say, look, I think that, I would just say the bigger issue will be with quantum computing in terms of current encryption, the existing encryption
We
standards.
can play upmanship all you want, but where is it going?
Well, but that's my point, meaning like, go on.
I think it's actually a good example. Classifying yourself as a person by voice is a classification problem. It's very well understood, very well done. So, but there is no prediction in that per se.
Is there what?
There is no prediction in that per se. Let's assume what would be a predictive component of that exercise would be, say, let's assume you're a trader at a big hedge fund and you come to work and they say, like, based on your pattern of your voice, and we see that you didn't sleep well last night, your level of cortisol high, you'll be making trading mistakes because maybe you had a fight with your own wife or you just were sick or something, your kid was sick, something like that. And that will say, hey, we'll limit your decision making for the next day until based on the pattern of your voice, that you get a full night's sleep and you will not be making some important bad decision. Does it make sense? So again, there is a classification problem and there is a prediction problem that what we are talking about.
I want to go down this way. Go on.
So what you're discussing right now has been done, of course, pattern recognition and finding inefficiencies and niches everywhere. Jim Simon built Renaissance on that very, very same premise. And why it was successful all the time, because it was hiring people, statisticians, all kinds that could make these correlations and do them with conventional database management, okay, and database. So people like Nick Roditi, who, by the way, I competed with him for the same girlfriend
Just a
I won.
You got the girl and he got the job?
I won. He won in other ways. So I'm from Rhodesia, like Nick was, okay?
Yep.
I knew him well. So the reason again is these individuals were not doing what other individuals were doing. They were rare birds, okay? What I'm pointing out earlier, that these techniques that are coming out with AI, as the backbone of these pattern recognition systems are going to be recognized very quickly. Other AI people are going to see the AI activity that one other machine is doing and immediately try look in this. In other words, these niches of inefficiency are going to be filled so darn quickly that it would, that my contention is in time, inefficiency will last nanoseconds.
Well, yeah, look, I don't disagree. The inefficiencies always have a half-life. You just look at any hedge fund investing. Clearly, you've been involved for some time and are knowledgeable. What was an alpha-driven strategy like merger arb, right, in the 80s or before, is now a commodity effectively, right? I mean, there's always, and look at any of them, there's always a half-life to strategies, investing strategies. So I think I don't disagree with you there. I'm just saying there's enough breadth of strategies, markets, durations, machine learning techniques, sources of data that there'll be plenty of opportunity for some time. But yeah, to your point, there is a half-life to all strategies.
I agree completely, and that's part of the evolution, right? And this is going to continue to evolve and expose new inefficiencies that we weren't aware of because we had bigger inefficiencies to tackle. But I have a question. I mean, Scott and Konstantin have models and they're out there marketing this to family offices and foundations and others. And you have purchased these types of systems. How do those family office evaluate these? How do we do diligence on these systems to say, yeah, this is a good one for me or not a good one? And you have experience doing this. And then I want to talk to you and Scott about, what are you going to let them see? Are you going to let them see the code? Okay, that was a question somebody had yesterday. So
Sure. Yeah, well, look, I would just clarify. I think, so there, I'll let Scott and Konstantin talk about their systems, but where I have immense experience is evaluating managers who are effectively running funds using machine learning and alternative data. And I've probably seen as many as most people in the world have over the last 7 years, and been invested in those managers and investing in quant strategies for 20 years. What we did, for example, is we created what we called a fund dimension template, which had 80 different parameters and ranging from, the data to feature discovery and construction to strategy development and back testing, execution and risk management, and software. And then within each of those were these 80 parameters. And what we would do is try to determine to what extent it's really the case that the fund is using machine learning and alternative data. And we use some principal component analysis, sort of rudimentary machine learning or technique or statistical technique to try to determine that. We also relied heavily on a team of PhDs from MIT who worked with us. So it was human plus machine ultimately, right? Because these strategies and techniques can be quite complex, and you have to be really careful. It is much more difficult than investing in a sort of plain vanilla discretionary strategy. I'll pause there.
Well, I was going to ask you maybe just to talk about what are the risks that you're most concerned with?
Oh, easy. Overfitting. People are relying on a back test. They found some pattern that existed that's entirely spurious and has no predictive ability. And what usually happens 99% of the time is someone has a back test. Of course, it looks amazing. He or she or they put real money in the strategy, and then it's a disaster. I mean, that's like it's kind of funny. I had a professor at Columbia Business School, and that person came to me many years later and said, hey, I have this strategy. And sure enough, he shows me the back test and it's amazing. And then you look at the actual and it's a disaster. What a surprise.
Because seen a back test that's not in the first quartile?
Exactly. And that doesn't account for the 95% or 99% of the back tests they threw out that weren't good. Anyway, I'll pause.
No, that's right. Scott, you want to pick up? I mean, you built your system from the ground up. It sounds very interesting to me. Talk to me about how you try to mitigate these types of risks when you're building your system and what you were considering.
Sure. It sounds like Michael knows exactly what he's talking about. You got to have experts in different verticals. So we found a smarty who taught advanced machine learning at University of Chicago. We're not just, obviously we're back testing, but it has to work out a sample a number of years, you know, with real capital. So we have partner capital in. There were years of really a scientific approach of trying to falsify what people call factors or data points that may have predictive value. So we ended up falsifying actually a majority of factors that have been talked about in the scientific literature and used in investing, and kept a large number of them, and then began testing them just by trading our own capital. And we've done that for 3 years, and have some pretty great results that unfortunately we can't share here. But I think Michael's right on the money. You have to, I mean, yeah, I don't mind somebody looking at the code to see if, like, let's say you're trading, you know, a common factor like value or something. Is that in the code? Yeah, you can sign on an NDA and have a PhD look at that, and it's either in the code or it isn't. And we're either, for us, we're not an algorithmic trader. The AI, just want to make this clear, is not making the trading decisions. It's scoring our universe of large cap liquid stocks. And then we make the decisions and do the portfolio construction. It's a very elaborate process. So the humans end up being in charge, but the machine learning, I just want to make this one point here that's interesting. You know, since the 1980s, you know, we've been able to do back propagation, where it's kind of a feedback loop where your model learns from future data about how successful it was, either on the upside or the downside, and can adjust. And so that's one of the great things about what we're doing is your system actually does become a bit more intelligent by training itself over time. But I think Michael's got the model for doing due diligence on these things, and you've either built it and it flies, you know, after 3 years or 36 months, or it doesn't. And you can look at the output and see if you had good input. So, you know, you look at, I mean, I look at the financial metrics and see if tail risk is controlled for, and you could go for a number of these things. But I'm a big tail risk guy because I know a market, it's not a Gaussian curve. It has really fat tails, but they only show up every few years. So if you're not controlling for that in your model, you're going to get blown up. So I think we've been really good about developing a system that avoids tail risk and just delivers in up markets and down markets. We pretty much sidestepped the 2022 bear market. We came out up. So these things do have predictive value. Konstantin knows this, Michael knows this. If you know what you're doing, you may not have visibility out a year, but you have some good visibility out a month, and it may decay over time, you know, over 6 months. But you do have forward-looking indicators that can be very useful for trading.
Yeah, and to Scott's point, that's exactly what we did. In other words, we would or do. We sign NDAs, and then, you know, we have our PhD sort of take a look at a sample of the code. And again, with small emerging managers, you can do that. Renaissance, where I've been invested on and off for 20 years now, you know, they're not going to show you the code. That's not happening. Right. But small emerging managers, they'll let you. And again, you're not like, we're not trying to steal the secret sauce. We're not coding a system ourselves. And we're, you know, again, you're signing an NDA, but just to get to see that it's real and it's really there, and it seems to make sense, and it's all cohesive.
Great. I just want to add up a little bit on what Scott and Michael were saying, and actually partially answers previous two questions in terms of the danger of overfitting and due diligence, which are partially related questions. And we phrase that internally. We obviously roll out new versions of our models all the time. Like literally yesterday, we rolled out a new macro regime risk on risk off model, and we are on duration 8 of our predictions. So we have the same problem. How are we make sure that the new generation is good enough, right? Should we write it in-house for quite a bit of time? So beyond sort of using a traditional in-out of sample and regularization, all the other traditional techniques, we started with actually the very high premise. Is the new improved approach methodologically makes sense? So i.e. fundamentally, like first principles, is this approach that new generation is better. And sometimes we actually don't even need to see better results. We believe in this approach that it should be better because it's structurally better, right? So we actually gain, that's why we use the human brains, how to build this model to incorporate some interesting effects of sustainable anomalies that haven't been captured. So this process of kind of vetting the models and approaches applies not only for external, for outsiders, but also us looking at our models when we roll them out live, right? So we face the same.
Yeah, I mean, we're effectively doing the same thing, right? You're doing more granularly at the manager level and we're doing it as an allocator. Agree.
Wanted to know, did you build anything into your models that helped out with risk management, investor relations, particularly explaining why it's making the decisions it's making, or anything to deal with regulatory controls or reporting, anything like that into your AI models? So that as it's making these decisions, recommendations, it's helping you also give the reasons and the grounding for those decisions.
Yes, and it's actually a very, very important question. I'm glad you brought it up. Biggest point why AI is not really used as much, not nearly as much. I mean, like basically still not used for investing. Again, I'm not talking about trading, but long-term investing, AI is still basically not used on Wall Street, right? We work with a big clients, and again, why? Two reasons. First of all, almost nobody has built it. We don't know too many successful shops which truly have in-house AI-driven predictions for their long to mid-term. They just do not exist. People are pretty good at high frequency mid-term, short-term to mid-term at best. And the second reason, actually, the degree of trust, and is currently hesitant about the black boxes. Yeah, people are comfortable putting their children on the planes, which actually 99% of the time are guided by computers. But they are hesitant to lose $100 or $100K on a computer, right? Which is an irony, right? So they exactly to Mark was saying, we spend quite a bit of time on making our models and conclusions less opaque. Yesterday we had a short sell on airlines, and it was driven by outflows into energy stocks. I make it not up. This morning I'm opening up like American Airlines and Spirit have a profit warning, exactly on that headline, right? But we spend a bit of time, so the models will be saying it explicitly, at least partially, right? This is a risk in the transportation sector coming because energy at some point starts hurting them. So the answer is yes and yes and yes. Perfect.
I'll just quickly add, I know we're running out of time, but it's funny because, right, CIOs and investment committees and, again, the people who run family offices are often like, yeah, it's quant, it's a black box. What's a bigger black box than a discretionary portfolio manager's brain? Like the discretionary portfolio manager can say, oh, I'm a value investor. And then all of a sudden the discretionary portfolio investor is investing in growth stocks. And, you know, that I've seen that happen, and I've seen very high profile, you know, multi-billion-dollar managers blow up for exactly that reason over the past couple of decades. Whereas if you code a system with machine learning and alternative data, there won't be style drift like that, and it's not a black box. It will do what you've coded it to do. Now, you need to code in risk management and parameters and a sensible system and all of that, but the machine won't go off the reservation. It will do what it's coded to do.
And when you go and you examine these things, and you have the interviews with the managers, is that a part of your line of questioning to them? How does it do that? How does it accomplish this?
Absolutely, and we want to know how often you override it historically, how often do you change the system, how reactive are you? All of that is part of the 80 parameters that we look at when we look at one of these managers.
So Scott, you've been a little bit quiet on your end up there, but a lot of good discussions going on. Talk to us about the things that these components that you may have built into your system as well.
Okay, thank you. I was going to say basically what they said. Also, you can look at the output. For example, you can look at a returns distribution and see where every trade landed, you know, and plot it on a graph. And you can see if you're playing anywhere outside of like one standard distribution to the right or the left, right? If we're concerned, let's say we're concerned about extreme risk or tail risk. If you've never landed a trade outside of, you know, 15% to the upside or 15% to the downside, you're well within one standard deviation after 36 months. Well, that tells you something about your tail risk exposure. right? So you can look at the output of the system that you've trained. I'm like a tail risk guy. I hate it. I don't want to have a trade that will possibly land, you know, and give me like 14% upside, because I know that potentially could give me 14% downside in the wrong environment. So I'm trying to land trades, you know, just to the right of the middle of a distribution. And I'm trying to like keep a really narrow returns distribution. So I don't have any, you know, I'm not saying I don't have any tail risk. I'm trying to actively manage tail risk, but I can see from the outputs in that return distribution how well I'm doing on an ongoing basis. So basically the quantitative metrics give us tools to see how well we're doing on all sorts of risk. So I take capital preservation and put that first, and then, you know, we built, I would call it an adaptive AI, or something that is regime aware. So when we're approaching, you know, the good times are about to end, maybe I just want like low beta stocks that don't move much, or, you know, we have a number of different strategies so that when the market drops, we don't drop with it. Maybe we want to have like half the, half the drawdown that the S&P has. Maybe we want a much faster recovery. So these are things that you can look at.
I'm getting the hook from Marty, so we have to be quick here. So I
Okay,
want to
sorry.
end it with
So
one
yeah,
last question.
Yeah, that's my answer. There are all sorts of ways to manage risk that you can build into it.
Beautiful. And if you want to know more, I would certainly encourage you to contact Scott, get into some discussions about his hedge fund and what they're doing. It's a great opportunity. We have different levels of family offices. Some are neck deep in AI, and some are, you know, ankle deep. It sort of reminded me, Evelyn Greck was on a panel with me a few months ago, and she was saying that any company that comes to me has to have an AI component, or I'm not interested. And that she's a venture capitalist and a pretty smart woman. It sort of took me back to like the 90s, right? You didn't have .com in the name. The valuation was, you know, half of what it should be, right? You just had .com. And are we seeing that now with AI? And how would you advise family offices that are looking to get into AI to avoid the pretenders from the real ones?
Well, first of all, for AI VC investing, so VC investing is something I've been looking at for many years now. Well, sort of 20 plus years. But the bubble in VC is AI. I personally would encourage families to avoid investing in VC AI now, because I think that is like the primary bubble in VC. Like the rest is largely deflated. And then I think investing in managers, again, if you have the capability to analyze and evaluate them that are employing AI, I think that's absolutely fine and sensible. I'll pause there.
Beautiful.
I very much agree with Michael on that point. Like, and simplistically speaking, everything that's investable in AI directly, from VC or even from the public markets, is so relevant.
Yeah.
References to the .com bubble are so relevant, right? Internet infrastructure, Amazon stock and Cisco, so these were good companies, like, and they did what they promised. Like from 2001 till 2008 or 9 were kind of flat after the drop. After the drop, they were flat for 10 years. Yeah. Even though they did exactly that they promised. They were building internet infrastructure, which even AI is using right now.
Yeah, I mean, I was at one of Marty's conferences, I don't remember how long ago, within the last 5-10 years, or maybe it's 10 years ago, and Microsoft had still been flat for many years, and I was saying there's value in these old line tech companies like Microsoft, Cisco, and those have finally reappreciated, right?
Scott, final word.
Final word. Oh, so, you know, generative AI, I was playing with it like in the 70s, and it's taken until now to achieve like mass adoption. People think it's new. It's very old technology. The guys at the forefront of maybe, I don't know, neural networks and programming these for investing, we've got a long way to go before the Wall Street and academia, catches up to what we're doing. Like, we're way ahead. It's going to, I mean, look at how much money is in index funds. It's going to be a long time. We've got a lot of runway ahead of us on what we're doing.
Terrific. Scott, Michael, Konstantin.